Hi everyone. Today we're gonna talk about portfolio optimization with sentimental analysis. This presentation is presented by Zijian Huang and Lubin Wang, two PhD students from Statistics Department. Oops. Next. First is our agenda. We're gonna talk about our motivation, and then we're gonna introduce the strategy. First is the sentiment analysis, and the second one is our optimization method. And then we will show the backtesting to show the performance of our portfolio. First is our motivation. So in this project, we focus on building a financial trading portfolio. Financial trading is the buying and selling of financial assets, also called financial securities. So there are various financial assets, stocks, bonds, commodities such as gold, silver, and oil, and so on. In our case, our target assets are the stocks in the US market. So even though we narrow down our target to the stock market, there are still numerous choices. For individual investor, it is very hard to keep tracking every stock to pick the optimal way. Moreover, Reddit's finance community, Wall Street Bets, has big influence on stock markets these days. The most famous example is the GameStop. The stock price pumps from $3 to $5 in early 2020 to 325 during January in 2021. For individual investors, we don't want to miss such opportunity, but we don't have enough time to keep tracking every post on Reddit. Motivated by this, we want to use deep learning method to help us select the certain stocks so that we can use portfolio optimization to boost our profit in short term. So to select target stocks, sentimental analysis is applied on several most popular financial communities in Reddit. First, let us briefly introduce what is sentimental analysis. So this is a simple example. We use IMDb movie review here. So let us mainly focus on the first two examples. Here we can see the deep learning models is able to predict the sentiment correctly, and the words in yellow are most related to the sentiment determined by deep learning algorithm. However, not every word is highlighted correctly. In example 2, the word for or the word have is highlighted, but not related to the negative feelings. To improve this, we use VADER, Valence Aware Dictionary for Sentimental Reasoning, to pre-process our words. VADER sentiment analysis creates a dictionary that links the word or phrase feature to emotion intensity, known as sentimental scores. The sentiment score of a text can be obtained by summing up the intensity of each word in the text. So here, for the word love and enjoy, VADER will mark it as positive sentiment, and for the phrase did not love, it will be labeled as negative sentiment. Moreover, it can also understand the emphasis of capitalization or punctuation, such as the word here enjoy, it shows strong positive sentiment. So in our example, it will help us to link the words to the sentiment to tell us how bullish a stock is. So here is the summary of our dataset. There are some predefined parameters. First, we defined which subreddits we want to research. Well, in our case is Wall Street Bets, stocks, and investing, 3 large finance communities on Reddit. Then we are going to filter certain posts that have this flair, such as daily discussion, weekend discussion, and discussion. We decided to pick top 500 hottest posts in the most recent week for those communities. And in order to guarantee the quality of the posts, we filter the ones with only upvote ratio greater than 70%. And for the comments within these posts, we only include the comments with minimal number of upvotes 2. And then we use the 25 most mentioned stocks generated by the sentiment analysis, and we will use the top 15 stocks to build our portfolio. So overall, we have 11,289 comments in 179 posts. So here is the result. So based on the first table, it showed 25 most mentioned stocks. We try to build a portfolio based on those stocks. And however, since there are too many stocks and some of them may turn out to be short, the scores could help us further filter the stocks. So after considering the compound score, we discard the stocks with negative scores. Moreover, PE here is a company that's most related to the energy, and its stock price is also more related to the energy price. Thus, it should be discarded from our final portfolio as well. So overall, our portfolio will include all these stocks with a red star beneath it, and those 10 stocks seem to be ideal invest targets for the short term.
This part is about optimization analysis. The next, please. And basically, there's two methods to calculate the returns. And for the first one is like simple return. And this is a very simple formula to calculate the simple returns, and which is simply today's price, for example, P sub T2 minus yesterday price P sub T1 divided by yesterday's price. And this gives you a percentage gain or loss for the day. And for the log returns, what is important to understand, though, it is a log returns aggregate across time. While discrete returns aggregate across time, since you build portfolios with multiple assets, discrete return makes the most sense to our project. Next, please. And this is the efficient frontier optimization, which is a constrained optimization problem in which we try to minimize portfolio variance by setting the weights. The top line is the the portfolio variance, and its weights transpose times the covariance matrix sigma times the weights again. And it's subject to condition simply state that the expected return, all the weights times mu. And it should be at least some target level of the returns. Then it is said that the weights should sum up to 1, and that at least some of the weights should be positive. Next, please. And this part is about some background knowledge, and that is Sortino ratios. And the Sortino ratio is a variation of the Sharpe ratio. It differentiates harmfully violated from overall violated by using the SS standard deviation of negative portfolio return only. So instead of normal standard deviation, in the Sortino ratio, you calculate the standard deviation of the negative return only, which is called a downside risk. And the reason why I introduced this is because we will use this to choose the best portfolios on the efficient frontier based on maximize the Sortino ratio and maximize the Sharpe ratio. Next, please. And this part is about back testing. And so we use the historical data to back test our performance, and we do the weekly trading here. Next, please. So, so the data we download is using the adjusted close price from Yahoo Finance by all chosen stocks from the 2021 June to the 2021 December. So it's about half year's data. And for this one is our benchmark. So here we have a 10 stock with equal weight, and they start from the 100, and the maximum price is 120, and they start decreasing really fast. So it seems not a good strategy. And yeah, based on these summary tables, we could see the total return for the benchmark is about 1.5%, and the daily Sharpe and the daily Sortino is pretty low. And however, the volatility is not the lowest one, so it seems not a good strategy. Yeah, next, please. And for this case, the backtest is based on normal calculated mu and sigma. We choose the weight of Microsoft about like 66%, and about for the NVIDIA, we use 33%. It turned out to offer us a really good results. Total return could be like really high because it starts from 100 to 150. So it become like a really high. And next please. So based on the table, we could see the total return is around 40%, and the daily Sharpe and the daily Sortino become like higher, and it's around like 3 and 6 respectively. And the volatility and is even lower than the previous benchmark one. Next please. In this case, we use the exponential weighted method to calculate the mean and the variance. And for this method, we choose the weight for the Microsoft is around like 35%, and NVIDIA is around like 58%, and Tesla is around 6%. It turned out to give us good results. And it starts from 100 to the maximum, which is 160. And it's even higher than the previous one. In this table, you could see from the exponential line, the total return is around 50%. The daily Sharpe and also the daily Sortino ratio is like just slightly smaller than the previous normal calculated mu and the sigma one. And also the volatility is like higher than the previous one. It's around like 30%. We think that's due to we include the Tesla stocks, and the variance of the variance of the return of Tesla is really high compared to the other stocks. So if we build up this kind of portfolio, that's the reason why we have like higher volatility. Next. And in this case, we use the exponential weighted mu, and however, we use the semi-covariance matrix here. And the semi-covariance matrix is just focused on the downside risk, and we'll ignore the positive gains because we are more focused on those kind of risk. And it's equivalent, in this case, equivalent to like we maximum the Sortino ratio based on these two parameters. Okay, and but however, in this case, it only include NVIDIA, and just a single stocks we choose, and the return start from the 100 to the 180 is the highest one compared to the previous case. Next. And yeah, obviously the volatility of this should be the highest among all the other because it just choose the single stocks and exclude other 9 stocks. And also the daily Sharpe and the daily Sortino ratio become like for the daily Sharpe is smaller than the others, but however, as I said, the daily Sortino is like higher than the exponential case, but however, is like lower than the normal case. And the total return is the highest among all the other cases. Next, please. Also, before say thank you to you guys, actually, I need to add a conclusion here. So according to the modern portfolio theory, pioneer Harry Markowitz in 1952, there is an efficient frontier of portfolio, each with the highest expected return for the given level of risk. We select the tangency portfolio, which is the portfolio with the highest Sharpe ratio. And the tangency portfolio is known as the max Sharpe ratio or MSR portfolio. And we pick the stock by using the sentiment analysis for the largest finance community in Reddit. Then we set the equal weighted stocks as our benchmark, and the performance is really poor. However, MSR portfolio turned out to have obvious better result by different mu and sigma. MSR portfolio by using exponential weighted mu and sigma should be an ideal portfolio, since it has a higher total return and a lower volatility compared with other 2 portfolios. Since our report is based on the short-term information, so it's crucial to rerun the code every week in order to detect the new hottest stocks in the markets and make the new portfolios. So thank you, guys.
Thank you.